Hi, everybody. This is Dr. Joe on this very nice Wednesday. Apparently, 70 degrees around here. This in the DC area. Hope you're doing well wherever you are. Another great session lined up. Today, we're going to talk about real estate tax tips, and how to maximize deductions and minimize liability. So it's kind of that time of the year. Everyone's thinking about taxes, and what we're going to do. Do I pay less taxes? Do I pay more taxes, and so forth? So I thought I'll do a session. As a disclaimer, I am not a CPA. I'm not a tax professional. So the information I share with you today, sort of a general nature, but always seek legal professional advice before you implement. But hopefully, it's going to be very helpful to you, and so on. So before I get too far, I just want to know that we let you know that we do have an event. It was scheduled for this Saturday, but due to a schedule conflict, it's going to be changed it to next Saturday, March the 23rd. And essentially, we're going to be visiting Femi's house. There's a student of mine who purchased the house a few months ago, completed the renovations, and he has now found a tenant. And the tenant will be moving in there very, very shortly. So I thought I'll do an event there and give people a chance to come in, see the property, and ask questions, network, educate, learn, and hopefully encourage you and motivate you to do this thing. So again, go back to the topic at hand today. It's all about minimizing deductions and minimizing liability exposure and things like that. So the question, I suppose, is why is mastering real estate taxation essential for investors? That's really the key. And as we all know, two things are certain in life: death and taxes, and so on. So, but in the world of real estate investing, there's significant opportunities, obviously, to build wealth, and but there's a lot of finance and complex financial situations and responsibilities that's associated with that. One of them, obviously, is taxation, paying your taxes. And you do have a legal obligation, but also you do, I think, as a savvy investor, you should try to use the tax laws to your benefit. So there's a certain level of strategy that's required. And depending on how well you do there, will have a big impact on your financial, profitability, I suppose, and also your ability to grow your portfolio. Because the less taxes you can pay, the more money that comes to you, the more money you can then reinvest and build a portfolio over time. So, so mastering this, I think, will provide you with opportunities, and also it's all good, and so on. So, what we're going to talk about today is lots of different areas, including the ability to leverage mortgage interest taxes or mortgage interest, property maintenance, depreciation, operating expenses. All these things come into play when you're trying to reduce your tax obligations and also increase your cash flow. So it's all about strategic planning and timing of property sales, and also leveraging some structures like tax deferral strategies like 1031 exchanges to protect your your returns, and hopefully help you build a sustainable long-term portfolio. I know it's a little dry subject, but it's, hopefully I'm going to try and make it a little interesting. Nobody enjoys taxes, at least I don't, but it is what it is, and so on. But again, as I mentioned at the beginning, it's really important to seek professional advice. And I work with a CPA, and in fact, I've been audited before, and it wasn't a very pleasant experience. But I got through it, and I got through it because I had the counsel and the advice of a great CPA. So I would definitely encourage you to seek counsel and work with professionals who know what they're doing, so they can maximize your cash flow and also help you grow your portfolio. So with that said and done, let's get on with it. So number one is, how can you maximize deductions for your real estate investments? That's the key. And so as I said before, every dollar saved through deductions is really a dollar that can contribute towards your profit margin. Okay, you save money on your expenses, which means that you increase your profitability. And so the question becomes, what expenses are deductible, and which ones are not deductible, and how do you maximize those deductions, and such that at the end of the day, you're better off for it. We all know about mortgage interest and property taxes, repairs, maintenance, and depreciation. They're all, affect the amount of taxes that you pay. As an investment property, you typically will be able to write off the interest payments that you make, the taxes that you pay. There's a difference between repairs and maintenance, which I'll talk about a bit later on. And one thing good about real estate is that it does, through the quirky nature of the tax laws, you can depreciate the asset. And again, I'll talk about this a bit later on. And to effectively, minimize the net taxes that you pay. So the question becomes is, in terms of expenses, some expenses you can write off immediately, immediate deductions, while others you have to depreciate over time. Okay, so for example, if you have a repair, you got a plumbing leak. I mean, case in point, I have. In fact, I was speaking to a plumber just about a few minutes ago. So I have a house where there's some plumbing issues. So I'm going to call a plumber. A plumber's going to go to the house, figure out what's going on, hopefully correct the problem, and it's a repair if he fixes the problem. So I'm going to write that off as an immediate deduction. Now, if there are some improvements to the house, like I do an addition, I do redo parts of the house, there are considered improvements, and those things are depreciated over a period of time. So you can't literally write it off all in one go. You have to depreciate over a number of years. So so again, I don't want to get too much into the weeds, but one of the good things is that as a business, the expenses that you incur for your real estate investments are tax deductible. And, and therefore, what you want to do is to minimize your tax obligations. And that implies things like timing. When do you buy? When do you sell? Because that will affect the amount of deductions that you can take. So there are some substantial tax benefits. I recall, when I was working, even though I had a large portfolio at the time, I essentially was probably paying less taxes than most of my colleagues who are working for the same company, and they're probably earning more than me. But because I was able to shelter a lot of my income and expenses through real estate, I ended up paying less taxes, and therefore, I was able to save the monies and then use the money which I saved towards, acquiring more properties, which in turn will allow me to pay less taxes. It's kind of quirky. I mean, that's the reason why people like, I don't want to say his name, but it is what it, people like Donald Trumps of this world. That's how they can amass a real estate portfolio and pay very small amount of taxes compared to the average person, because real estate, is known as a real good tax shelter, and so on. So there are tax benefits associated with real estate, holdings, but obviously the tax laws change. They're constantly changing, and therefore some deductions are available today that may be not available next year, and so on. And likewise, some new opportunities occur that you may be able to take advantage of as time goes by. So it's kind of a dynamic situation. But through real estate, you can maximize deductions and therefore offset some of your expenses. Okay, so what are some of the action items associated with maximizing deductions? I would say regularly review your expenses that you do. It's really important to track the inflows and outflow of money. In my case, I have several things which I do. I have a bookkeeper. The bookkeeper is the one that she's based out of Canada somewhere, and I've never actually met her, but she's really, really good. I've been working with her about 14, 15 years. Shout out to Charlene. And so essentially I track all the inflows and outflow of monies in my accounts, several bank accounts, and then she categorizes those inflows and outflows using a tool called QuickBooks. And we do that on a regular basis, usually every week. And so every month she'll reconcile the accounts. And once she reconciles it at the end of the year, she'll then put it all together, which we then give it to the CPA. And the CPA will then take that information and then develop our taxes, tax returns, and things like that. So that's how I use it, and that's the game plan which I use. So regularly review your expenses to identify potential deductions and ensure accurate record keeping. Understand the difference between repairs, which are immediately deductible, and improvements, which are depreciable over time. And as I mentioned before, consult with a tax professional to develop a comprehensive tax strategy tailored to your investment portfolio. So I know it's kind of dry. I get it. You know, it's not. This is not sort of the sexy stuff, but you know, hopefully I'm going to try to make it as. Hopefully I'm not going to bore you guys to sleep anyway. So that's number one. Is some of the strategies you can do to minimize your deductions. The next thing is strategies to minimize your tax liabilities. You know, and obviously minimizing your tax liabilities is really you know, is critical in order to maximize your deductions. So this involves several things, and one of the things that a lot of people don't consider is the legal structure of their entities, you know, their property holdings. So a lot of people have you know, there's LLCs, there's S corps, there's C corps, there's partnerships. There's lots of different, you know, legal structures which you can, you know, hold your real estate assets in, and also to run your real estate operations through. So I think that's important. Is in order to minimize your tax liabilities, the legal structure that you use. The other thing is to understand the whole concept of capital gains. And capital gains, you know, whenever you sell an asset and hopefully you make money, then you're going to, you know, Uncle Sam wants their piece of the action. So you're going to make gain, and you're going to be subject to a capital gain tax. And again, depending on the type of asset that you have, whether it's a short-term asset like a flip or a wholesale deal or something like that, versus a long-term hold, because they have different capital gains rates. Long-term rates, long-term holding stuff for a long term, which is usually more than 1 year, you tend to pay less taxes than if you hold on stuff for less than a year, like flips. You pay a higher tax. So there's a choice between individual. You know, if you want to hold assets, for example, as I said before, you can hold it in your personal name, individual. You can hold it through LLCs. You can hold it in S corps, and these will have significant tax implications, and also will have an you know, some exposure, liability exposure as well, you know, associated with that. So capital gains, as I said before, is a pivotal part of this. And you obviously want to pay less taxes. And that's the reason why I hold on to my properties for at least a year. I hold them on for 5, 10, 15, 20 years. So that if and when I sell them, I'm subject to less capital gain. And the other thing is property depreciation. I mentioned earlier on that one of the things about you know, real estate is that you can depreciate the asset over a period of time. So single families is typically 27.5 years. And but if you understand the tax laws, I'm going to talk about depreciation in a couple of minutes, a bit more detail. But you can minimize your tax liabilities through depreciation, and also you can minimize your tax liability through a vehicle, what we call 1031 exchanges. And that's a powerful tool to defer capital gains taxes by reinvesting the proceeds from a sale onto another like-kind exchange. Again, I'll be talking about that one in a bit more detail a bit later on. But these are strategic planning strategies that you can use. And if you know how to play it, you can use those strategies to reduce your tax liabilities. So again, you know, you want to obviously maximize your deductions, as we said in number one. And the next thing is you want to minimize your tax liabilities. And you can do that through the entities that you hold your assets through, and also through other creative strategies like 1031 exchanges and minimizing and reducing your capital gains taxes. So what are some of the action items associated with minimizing tax liabilities? Things like evaluate what's the most beneficial legal structure that you should run your real estate businesses through. You might want to consult with a tax advisor when you decide that. And also you want to plan for long-term real estate investings to take advantage of long-term capital gains tax reductions. Okay, the third thing we want to talk about is the importance of depreciation in real estate taxations. I mentioned that a little earlier on, so I'll go into a bit more details here. The whole concept of depreciation and how it applies to real estate. Depreciation is a critical and often underutilized tax strategy that's available to real estate investors. It allows you to recover the cost of an income-producing property over its useful life by providing annual deductions that can really significantly reduce your tax obligations. So what it means is that let's say you got a house. The way the tax laws are is that it's an asset. An asset is typically you can depreciate over a period of time. But we all know that real estate, although it's an asset, it is an asset, but it actually appreciates in value. It actually increases in value. So from a tax standpoint, you can write it off, you can reduce it, you can depreciate it, but we all know that it's actually appreciating. So you can, if it's a single family, you can depreciate it over 27 and a half years. And so you can write off part of the income that you get and write it off against the depreciation that you will offset that. I know it's kind of I don't know if this is kind of dry, but if you follow what I'm saying, but the idea is that there are significant tax benefits associated with owning real estate through things like depreciation. And the amount you can depreciate obviously depends on the classification of the property and and the useful life of the asset itself. Again, I know it's kind of a dry subject, but just bear with me. But these are some of the strategies you can use. You want to depreciate your, real estate offers you depreciation capabilities, and which will then in turn reduce your taxes. So what are some of the action items associated with something like this? You want to familiarize yourself with the basics laws of depreciation, how it works, and how you can leverage it to your advantage. And you want to differentiate. You have to understand the differences between repairs and improvements, so you can properly categorize your expenses. And likewise, you want to speak to a tax advisor, and hopefully they can help you make sure you implement the right strategy. Okay, so we're going to be going to Q&A very shortly. And so if you've got some questions, please put them in the chat box and I'll get to them. Next 15 minutes or so, 10, 15 minutes. If you've got some questions you want to throw out to me, anything to do with real estate investing, anything to do with taxes, anything to do with buying a house, renting a house, selling a house, getting tenants, fighting with tenants, whatever it is, put them in the chat box. And I will get to you in about 10 minutes from now in the Ask Dr. Joe segment of the Q&A part. Okay, so let's go on to number 4. And navigating the complexities of Section 1031 exchanges. Text 1031 exchanges. What am I talking about? Okay, so whenever you sell an asset like a real piece of real estate, you're going to be subject to capital gain, as I mentioned earlier on. Now, you can defer that through a creative strategy called 1031 exchanges. And that allows you to defer the capital gains that you ordinarily would pay and defer it. And you exchange your asset for a like kind other asset. And so in doing that, you defer or you delay the capital gain that you ordinarily would pay. So, but there are, some rules associated with this, some quite complex rules, and that IRS has put in place that you need to adhere to in order to actually realize this. So it depends on certain things like, does the property that you are exchanging into qualify? It only applies to investment properties, not to your primary residences. And there are some timeline restrictions in terms of when You got to buy your property, when you got to buy the next property, and and all that kind of stuff. So there are some timelines that you have to adhere to. I'll talk about that in a second. And your replacement property, there's some rules associated with that. And also there are rules associated with handling the proceeds. You can't touch the proceeds. It has to go through a third party, which I'll talk about in a second. Anyway, so understanding what a like-kind exchange is crucial. And there are broad categories which is within the scope of outside the scope of this meeting. But typically, you got to find a replacement or identify a replacement property within 45 days. 45 days of the sale of your original property. Okay, and you've got to complete. So you got to identify the next property you're going to buy within 45 days of the sale of your current property, and then you have to complete the purchase of the replacement property within 180 days. So there are some strict guidelines that you have to adhere to, and it does require some planning, and it does require a level of coordination. And the other thing is that you can't touch the proceeds yourself. You have to go through what we call a qualified intermediary, okay, a third party. And they're the ones who handle the transactions. They're the one who handles the money. The money can't go through you. It's got to go through them. And otherwise, you'll invalidate, the benefits associated with a 1031 exchange. So again, there are some complex rules associated with 1031 exchanges. I haven't done a 1031 exchange before, so I'm not an authority on this. I know a lot of people who have, and but if you're considering this strategy, you have to understand what the rules, the do's and don'ts, and also you need to get a qualified intermediary who will sort of coordinate the transactions for you. But 1031 exchange is really a good way to expand your portfolio and build a portfolio in a relatively short period of time, because you're trading the gain that you ordinarily would pay in taxes onto new properties. So some people will sell one property and buy 2 or 3 properties and so forth. So you can use it as a strategy to really build a portfolio. So what are some of the action items associated with 1031 exchanges? Educate yourself, obviously, on the definition of a like-kind exchange. Educate yourself on the timelines that's required, and just engage with a qualified intermediary if you want to do this, but just become knowledgeable about the whole process associated with 1031 exchanges. Another strategy that you can use to reduce your tax obligations is what we call leveraging tax credits. Again, this is a bit more advanced strategy, so I'm not going to go into too much detail, but there are things called tax credits, which can significantly reduce your tax obligations by using almost like a dollar for dollar reduction in tax liability. So if you have a tax credit for $1, that will then reduce your tax obligations by $1, and so forth. These are typically, done for things like developing affordable housing, renovating historic buildings, making energy efficient improvements. So there are ways where you can get tax credits, and that's, again, it's going to require a bit more planning, a bit more research. And I haven't ventured into tax credit strategies, so again, I'm not an authority on this, but I wanted to at least share that with you. So at least if that's something that appeals to you, then you can do some more research and you can explore it further. So obviously, you want to make sure that you are eligible, you meet the criteria. You want to make sure that there is an application process and that you understand what the application is, and also it's important that you are compliant with the requirements, whatever they may be. So these are some of the action items. And number 6 is the role of the professional tax advisor, in real estate investing. So it's really important, obviously, to have the right advice, the right counsel, and to make sure you do this, properly. This is absolutely important. As I said before earlier on, I've been audited by the IRS a number of years ago. It wasn't pretty. It was pretty brutal, to tell you the truth. But it was okay, because I had a a tax advisor who helped me through the whole process. And I ended up actually getting more money back from the IRS than what I thought I would be. So I was expecting to pay money, but I ended up getting a refund. Can you believe that? So it wasn't so bad after all. But I was able to do that because I had good advice. I had a great CPA that I worked with, that worked with me, I suppose, through the whole process. So I can never say how important it is to get good professional advice and work with the right people who can minimize your taxes, increase your deductions, but do it in compliance with the tax laws. And that way you don't run yourself into problems and so forth. So, I've been working with CPAs for at least 20, 25 years. Yes, you have to pay. They're not free. But for a dollar per dollar, it's worth it for me. I obviously have a portfolio, so it's kind of complicated, but I think it's really good idea to work with tax professionals, and not just for doing your taxes, but also to help you strategize, develop a plan, and how to maximize the tax laws to your favor. They can advise you on things like property acquisitions, sales, when to sell, how to sell, 1031 exchanges. There's lots of different things that you can do with a tax advisor to make sure that you're compliant with the tax laws and you optimize your tax position. So again, engage with tax advisors. They do what they do best, and you do what you do best. And you can create a win-win. So what are some of the action items associated with this? Establish a relationship with a tax advisor who specializes in real estate. Not all tax advisors, not all CPAs specialize in real estate. But I think there's an advantage in finding somebody that does. Schedule regular consultations with your advisor. You can review your portfolio and also, revisit your tax strategy. And also, you want to involve your tax advisor in major transactions and strategic decisions. And finally, in conclusion, to wrap it up for today, it's about 7:30. Transforming tax. Taxes is not a pretty word. Nobody likes it, but you can use it as an opportunity. By understanding and applying the principles of maximizing deductions, minimizing liabilities, leveraging tax credits, and engaging in strategic planning with the assistance of a professional tax advisor, you can really significantly enhance the profitability of your investments, but also the sustainability of your real estate portfolio over time. You can use the tax laws to your favor, in other words. And so again, in today's live stream, I know it's a dry subject, but hopefully it wasn't too boring. But I've tried to share with you a roadmap for navigating the complexities of real estate taxation laws. But at the end of the day, it does require knowledge on your part. It does require strategies on your part, implementation strategies, and also it does require professional guidance in order to use the tax laws in your favor and to your advantage. So, taxes aren't necessarily a burden. You could see it as an opportunity to optimize your investments and also ensuring your long-term growth and financial security. So, armed with this, go forth to battle and, let the tax laws work in your favor. And hopefully today wasn't too boring, but I try to share with you some of the strategies to minimize your tax obligations and also to leverage the tax laws in your favor. So again, we're going to go to Q&A in a second. So if you've got some questions for me, please put them in the chat box and I will get to them in a second. And if you want to email me, you can always reach out to me. I'm at joe@joeasimo.com, joe@joeasimo.com. And you can shoot me an email. I'll try my best to respond. And for those people who would like more one-on-one time with me, you can book a one-on-one Zoom meeting with me. You go to my website, www.joeasimo.com, www.joeasimo.com, and you can schedule a one-on-one with me. It is payable. It's not free, so just full disclosure, it's $175 for now. But I've been holding quite a few of those recently. and they've been really, really good. And everybody that's had a session with me has really, really enjoyed it. If you got a problem, rather than trying to figure it out or getting frustrated, just book a session with me and let me see if I can work through it with you. No matter what the subject is, whether it's anything to do with BRRRR, landlording, tenants, screening, buying, Section 8, whatever it is, I'm more than happy to allow you to leverage my experience and my lessons learned and trials and tribulations as well. So with that said and done, don't forget next Saturday, I do have a one-on-one meeting. An education networking event. That's Saturday, March the 23rd at one of my students' house, Femi's house, here in Washington, D.C. So if you're in the Washington, D.C. area, you definitely want to come. And you'll see in real time a project that he's done from start to finish. He purchased this house a few months ago, renovated this house. He financed the house, renovated it. And we now found a tenant. And the tenant, we've completed all the Section 8 paperwork, submitted that in. And now it's a matter of just waiting for the inspections and waiting for the tenant to move in. And then he will then refinance the property in order to complete the BRRRR, buy, renovate, rent, refinance, and repeat. That's it. So kudos to Femi. Also, I want to give you a shout out to Corliss and Fritz. They bought their house a couple of weeks ago here in Washington, D.C., and that's going on very, very well. It's a 3-bedroom, 2-bath house, and they are turning it into a 6-bedroom, 4-bath house. And they're also going to implement the BRRRR strategy. And so kudos to them. Congratulations. And I'll be working with Fritz and Corliss to complete that project. And so far, we did the demo this week. And I think the inspection was done today, passed through that. And now we're getting on to the next stage, which is finalizing the design and then doing more of the major rehab and things like that. So kudos to Fitz and Corliss. So with that said and done, let's get down to Q&A. And let's see who's... you got some questions, put it on me. Janitor on fire. Oh, my goodness. Janitor on fire. Hi, Janitor. Hope you're doing fine. Next question is Ty. Hey, Ty. Hope you're doing well. I like how you put that, Dr. Joe. Tax savings can be considered as part of profit margin. Yes. I mean, if you're able to save $1 in taxes, it means that it's going to increase your profit margins. So, of your real estate investment. So if you can use the tax laws in your favor, you can increase the profits that your assets will generate. So that's how I do it. Is you're working hard to build this portfolio, and nobody enjoys paying taxes. I'm not saying you shouldn't pay taxes. You have to pay, but why pay more than what you need to? And that's why if you have an understanding of the tax laws and get good advice, you can reduce the amount of taxes that you pay, which in turn will increase the bottom line to you. Okay, next one. B. Francis. Good info, Dr. Joe. Thank you. B. Francis. Again, if you got some questions, please put them in the chat box, and I'll do the best that I can to answer them. Anything to do real estate, put it out there, and I'll do the best that I can to provide you with useful answers. B. Francis, thanks, Dr. Joe. Okay, thank you. Ty, how do you decide whether to keep a home in your portfolio, 1031 exchange, or sell it altogether? Good questions. Okay, how do I decide when to keep a home in my portfolio, 1031 exchange, or sell it altogether? Okay, so case in point, I have a house, which I think I had a session event there a couple of weeks ago. Well, I bought a house about 10 years ago here in Washington, D.C. And, the tenant left. And so I had a choice. Do I, re-rent the house? Do I sell the house? Do I 1031 exchange it into something else? Or what do I do? What's my exit strategy? And these are the options available to me. The house had gained in appreciation over the last 10 years. So there's quite a bit of equity there. And so the question becomes, what do I do? I have enough houses, as you know. So I thought, well, maybe I don't need to. Let me just, sell this house. I mean, at some point, as they say, you want to enjoy the fruits of your labor, as they say. So I thought, well, it's time to enjoy this ride. And so I decided to sell the house. I didn't want a 1031 exchange to something else because I didn't want to acquire more properties. I've got enough. So I've decided to sell the house and sell it all together as opposed to re-rent it or 1031 exchange for new properties. And I'm at peace with paying the capital gain that's I'm going to be subject to. But I'm okay with that because I want to have a payday. And there's nothing wrong with that, I don't think. And so on. So it just depends on your situation, Ty. If you're in the growth phase of your journey, then you may want to 1031 exchange to build a greater portfolio, get more assets into your portfolio. If that's where you are on your real estate journey. But I'm not there. I've passed that point, so I don't need to build anymore. I'm now sort of in the stage where I'm preserving and protecting the portfolio that I have, and every now and then, it does make sense to me anyway to just sell something, enjoy the appreciation of the asset, and pay a couple of bills and go on vacation. I don't know, but that's where I am anyway. But other people, you may not want to do that. You may want to 1031 exchange it, or you may want to just keep the asset and re-rent it, and so on. So another house of mine where a tenant, in fact, one of my tenants, she just left this week. She was with me for 8 years. It's a 4-bedroom house, and she has been downgraded from a 4-bedroom voucher to a 3-bedroom voucher. And so she just found a property, and she just left yesterday. We did a walkthrough yesterday. So that house I've owned for about 8 years, and I'm going to keep that house. I'm not going to sell it. I'm just going to re-rent it. So again, it depends on the case-by-case situation. The other house, I just decided to sell it. But this other house, I'm decided to keep it and just re-rent it, get another tenant in there, and just keep rolling. So it just depends on where you are. I don't want to acquire more properties. I'll just want to keep my properties that I have, and every now and then just sell something if I so desire. That's a good question, Ty. And any tax credits you've been able to take advantage of, Ty? You got some good questions, Ty, today. Again, if you got some questions, please put them in the chat box and I'll get to them as soon as I can. I haven't used the tax credit strategies, so I'm not really an expert in that area. I know that there are some other real estate investors, they do that. I just haven't, but I wanted to share that with you during the presentation because it is a strategy that you can use to reduce your tax obligations. But I don't have any experience to answer your question, Ty, in that area. So so I'm not the right guy to answer that question, but you can do some research and see if it makes sense for you. Joe Che, can you guide us through underwriting and estimating rehab costs? Okay, good questions. Can you guide us through underwriting and estimating rehab costs? Okay. Let's have a look. See if I can take this one on. Underwriting. Well, we all know that. There's different levels of underwriting. So, whenever you buy a house or an investment, and you're going to get money, borrow money from either a lender, a hard money lender, a bank, or financial institution, they're going to have to make a decision as to whether they're going to do the deal or not. And so they go through a process, what we call underwriting, where they sort of look at the numbers, look at the financials, look at you, determine whether they should give you the money or not. Okay. Just because you talk a good game doesn't necessarily mean you'll get the money. They're going to do their own due diligence on you. They're going to check your credit. They're going to check the house. They're going to check you. And they want to know more about what are you going to do with this house? Are you going to rehab it? Are you going to flip it? Are you going to hold it? And so on. So that's my understanding of underwriting. It's the due diligence process that the financial institution will go through in determining whether to borrow you the money or not. The second part of your question, Joe, is estimating rehab costs. And typically, what I do is I will go to a house. Let's just say a scenario is I get a call from a wholesaler, and the wholesaler says, "Hey, Dr. Joe, I got a house at 123 Main Street. It's a great deal. You can buy it for this price. It just needs this amount of rehab, and you can sell it for this amount." Okay, and they usually inflate the ARV, the after repair value. They tend to underestimate the repair cost in order to make it sound like it's a great deal. I get it. They're trying to peddle this deal to somebody else, and and so on. So it's up to you now to check the numbers. So typically, you're going to buy a house that requires some level of renovations. So you have to have some idea as to what the cost of the renovation is going to be. And I have a ballpark, like a spreadsheet, which I use. So what I will do would be to, when I go to a house, straight up front, I say, okay, then, does this house require minor renovations, mid-level renovations, or major renovations? Okay, is it minor, middle, or major? That's the first thing I need to ask myself. And so what's the definition of minor? Minor is typically things like painting carpet, and you get in, get out, you're done. Doesn't require much work. Middle level is when you may have to, take out some walls, replace this, replace the bathroom, replace the kitchen. That's more of a mid level. It's not cosmetic, it's a bit more mid level. Okay. Major is when you're really redoing a lot of things, if not everything. And you're moving stuff around, you're taking walls around, you're updating this, the plumbing, electrical, the mechanicals, you're doing all those upgrades, which you wouldn't do in the mid level and the minor. So major level renovations, obviously it's more expensive, it's going to take more time, and it's more costly. So how do you estimate that? Just based on experience, I can get an idea when I go to a house and say, okay, it's going to be $100,000 renovations, 150,000. I mean, that's just experience for me. However, there are tools out there where you can plug in the numbers or plug in, what you want to do, and it'll give you an idea, how much it's going to cost. How much is it replacing the windows? How much is it going to cost to replace the kitchen? How much is it going to cost to update the bathroom? How much is it going to cost to do the roof? All those things you can plug into the software, and it'll give you an idea of what the total is going to be. Another thing you can do is to approach a contractor, and you take a contractor to the job, and you explain to the contractor what it is that you want to do, and they will then give you an idea, given the scope that you've described, how much it's going to cost. So that's another approach that you can take, is to actually take a contractor with you, and they'll give you an idea how much it's going to cost to get the job done. So the different approaches, it depends on, again, how much experience you have. If you don't have much experience, I would suggest that you take somebody with you who can give you a better idea. Otherwise, you can work on your scope and then plug it into some of this software out here, and they'll give you an idea of how much it's going to cost. And the cost will depend to a certain extent on where you are in the country, because if you're in a high labor cost area like we are in Washington, D.C., New York, L.A., major stuff, the cost of labor is higher than if you're in some places where the cost of labor is lower. And so it may cost you less in some places, but more in other places. So I think where you're based is going to factor in. And but the biggest factor is going to be your scope. What is it that you actually want to do as part of the renovations? Because once you have defined the scope, and this is the key, once you define the scope, and you can document that, then you can give it to different contractors in order to get some estimates as to how much it's going to cost. Okay, good question. Hopefully I answered your question, Joe. Let's have a look. Next one. One more. Ty. Yeah. I know this is not one more. Thoughts on property taxes since they capped how much we can write off at the 10K, I think. Property taxes. Well, I don't know what I mean. The way I see it, again, I'm not a CPA. Property taxes are expenses. I'm not too sure if you can. I mean, it's an expense on your business, so you should be able to offset your expenses against the income that you make. So I know that when I claim my taxes, property taxes for my properties, I pay taxes. I put it on the it's a write-off, and it goes from me to the bookkeeper, and the bookkeeper puts it onto the reconciles everything and sends it off to the CPA. As far as I know, you can write off your property taxes if it's an investment property. Now, if it's your primary residence, maybe you can't do that. But if it's an investment property where you are renting out, and there may be some other caveats. Again, I'm not a CPA, I'm not a tax professional, so but I'm pretty sure that there are limits. Yes, what those limits are, I don't know. But as far as I know, I'm writing off my property taxes for my investment properties. Okay, intellectual conversation with BJ. Hi, Dr. Joe. While visiting Jamaica, has your mindset changed on investing in rental properties overseas? Hi, Dr. Joe. While visiting, I went to, as you know, I was in Jamaica. I went to Jamaica, Bahamas, Cayman Islands, and Cozumel, Mexico, a couple of weeks ago on a 7-day cruise. Great time, fantastic. Enjoy myself. Would I invest overseas? Probably not. No, I like to invest where I'm located. I'm a sticker for control. I don't even buy properties outside of the Washington D.C. area because I like to know what's going on. I like to if something's wrong, I can go and take care of it and so on. So I'm not really a firm believer in long distance investing, let alone overseas investments. When it's overseas, then you got other issues you got to deal with. If something happens, you got to fly over there. You got currency issues. I think in Jamaica, it's like 152 Jamaica dollars equals $1 US. So you got currency issues. If you're investing overseas, so if the local currency, goes down or goes up, it's going to affect your profitability and so on. So anyway, overseas, probably not for me because you're totally at the mercy of other people. I don't live there, and therefore I'm going to have to rely on other people. And sometimes not everyone's looking out for your best interest. So that's just the reality of things. So I'm not saying you should not invest overseas. It's just that I don't do that. But I know there's a lot of people who do. And so, and they are happy with their investments. And so kudos to them. It's just that I'm not there. I rather invest close to home. And so that way I can keep an eye on it. And I can make sure that my assets are being protected. The best, the person who's going to be more concerned about your investments is you. You can't expect somebody else to have the same level of concern about your investment as you. And if you don't concerned about it, then you can be sure other people aren't as well. So that's the reason why I like to stay local. But again, everyone's different. A lot of people have been very, very successful investing long distance, also overseas. So who am I to judge? And but do whatever is more comfortable for you. But I haven't changed my mind in terms of investing long distance or overseas. Maybe in future I will, but not right now. Okay, Katie, if excluding in favor of vouchers, how do you ensure fair opportunity for applicants? If excluding in favor of vouchers, how do you ensure fair opportunities for applicants? I'm not too sure what the question is, but let me see if I can take a stab at it, Katie. Whenever you are renting a property, there are laws, fair housing laws that you have to be compliant with. You can't discriminate against what we call the protected classes, race, national origin, color, gender, sexual orientation. There's lots of different what we call protected classes on a federal level. There's also protected classes on a local level and a state level. So you have to be compliant with those those laws. And if you're going to be, the best way to remain compliant is to have policies that you apply across the board when you are screening and selecting tenants. So for example, I let people know that when I'm going to be, if someone's interested in my properties, we're going to contact the current landlord, previous landlord. We're going to check income and credit. I also require that I go visit the person's home. So I do that across the board. I don't do that just for voucher holders and not for non-voucher holders. I do that for everybody. And so typically, if you have policies and you apply those policies across the board to all people, then and you don't sort of say yes for this person, not for that person, then you should be okay, as long as you're not screening against any of those protected classes that I talked about. So that's what I do. I have a policies. I let people know up front. I apply it consistently across the board for everybody, and whether it's voucher holders, non-voucher holders. The thing about voucher holders, I find anyway, is that in some parts, especially in some areas, the housing authority pays slightly higher rents, the market rent. So if I place an ad and the rent is higher than the market rent, for example, then I'm probably not going to get too many applications from market renters. I'm just going to get voucher holders because the rent is above what the market is. So, many times all I get are applicants from housing choice vouchers. So, which is fine with me because I have no problem renting to voucher holders and so on. So again, you got to make sure that you have a policy, you apply the policy consistently across the board, and that way you don't sort of go against any of the fair housing laws at the federal, state, or local level. Good question, Katie. Joe, do you GC your own deals, source your own subs, or do you farm it out for said cost estimates? Okay, so Joe, do you GC your own deals, source your own subs, or do you farm it out for said cost estimates? Okay, so what I think you're saying is that when I do a rehab, I use I have contractors who I've used the same contractors for the last 10, 12 years. They're the only contractors I use. I don't do the work. I don't demo. I don't sort of run plumbing line. I don't do that. I'm sure I could do it, but I don't enjoy it. So I'm not very good at it anyway. So I'd rather work with people who are good at that, who enjoy it, and they get it done a lot faster than me. So I outsource all my renovations to a third-party company, same company for my projects. The reason why I use them is they're reliable. They get the job done without drama. They're not the cheapest guys in town, but they get the job done and without a whole lot of back and forth, without a whole lot of stress. And if you've had some contractor challenges, let's just say, then you know what I'm talking about. Good contractors is absolutely crucial for your sanity. And if you want to be in this business, and it's hard to do it without good contractors. So if you find good contractors, they're worth their weight in gold, and do what you got to do to keep them. And so that's what I've done. I found good contractors. I use the same contractors for my projects, and they're the ones who do the plumbing, the electrical, the HVAC, the framing, the roofing, all that stuff. And they give me a price per the scope, and we haggle, we agree, and then we write the contract up, and then we get the job done. So that's how I do it. If you don't have those contracts in place, you may want to go to a local RIA, Real Estate Investment Association meeting, maybe speak to other contractors, other investors, see who they use. You may want to go to the Home Depot or Lowe's and speak to the Pro Desk and see who they can recommend. So there are lots of different ways you can find a good contractor. It's not easy, believe me, but that's what I do anyway, Joe. I just farm all my work out. I don't do that stuff. Okay, Katie, Apologies. First part of my question got cut off. Hi, Dr. Joe. Thanks for tonight's info. During the application period, do you often get non-voucher applicants? Do you exclude or consider these applicants? Okay. Again, if you got some questions, put them in. I got a couple more minutes left. Maybe, I may be able to get one more question, but it's 7:56, so we're gonna kind of wrap it up now. So during the application period, do you often get non-voucher applicants? It depends. As I mentioned earlier on, Katie, is that depending on the rent, I may or may not get any non-voucher applicants. If the rent that the housing authority pays is higher than market, then I'm probably not going to get too many market renters. If I do get market renters, yes, you have to consider them. Yes, you go through the same process. You show them the house. You let them fill an application form. You screen. I do have some non-voucher tenants. Not all my tenants are voucher holders. So sometimes the best applicant is a non-voucher holder, and so it just depends. As long as you apply your screening process consistently across the board, you pick the best person. And I like vouchers, and most of my tenants are voucher holders in the DC area. There's an absolute shortage of quality houses in quality areas that landlords accept voucher holders. So I never have a problem getting my properties, get applications. My challenge is making sure I got good tenants, and that's where screening comes in. So I don't exclude, voucher holders or non-voucher holders. I don't do that. You get yourself in problems if you exclude people. So just take the application as they come, screen them as they come, and then you make the best decision based on what comes out of that whole process. Okay, I think we're done for the day. It's now 7:57. It is now 8 o'clock. So again, on next Saturday, we do have a networking and education event at the property that Femi, a student of mine, has just completed. Please come attend. I think it'd be great. I think you'll enjoy it. A great chance to network, meet other people, and see firsthand what it takes to get a job done. A BRRRR project from start to finish. Femi, I'm sure, is like a lot of you, in the sense that he was concerned. He wanted to get into real estate, but he decided to pull the trigger and make it happen. And this is the project that he's completed. I mean, I helped him through the process, but kudos to him for seeing it all the way through from start to finish. And it'd be great for you to learn from his experiences, to hear what his story is like, and also get a chance to walk through his house. And hopefully it'll motivate you and encourage you to pull the trigger, and so that you can pursue your own real estate financial independence goals. So again, if you got email, shoot me an email, joe@joeasimo.com. And likewise, if you want to do a one-on-one session with me, feel free to book a one-on-one with me. Go to my website, joeasimo.com, and it's called Ask Dr. Joe. You can book a 1 hour one-on-one with me. Anything to do with real estate, landlording, tenants, buying, renting, you name it. There's a pretty good chance I've been through it, and hopefully I can help you avoid making what I call unnecessary mistakes. So with that said and done, it is now 8 o'clock. I'm going to wrap it up for the day, and I'll see you next Wednesday on a Wealth Wednesday, and hopefully I'll see you next Saturday at the event that we're going to have. So take care. I'll speak to you guys later. Take care. Have a good one. Bye for now.